Welcome back to Everyday Economics, the podcast that helps you learn about the economic world happening around you every day. I'm your host, Chris Krug, CEO of the 501c3 nonprofit, nonpartisan Franklin News Foundation. Everyday Economics, a production of America's Talking Network. You can subscribe to all of our podcasts at americastalking.com. To support Everyday Economics, please make a tax-deductible charitable contribution by clicking the link in the show description. We are recording this episode on Monday, April 8th. And joining me as always, the great one, Dr. O, Orphe Divounguy, the PhD economist. Hey, Dr. O, I want to congratulate you on the launch of your new newsletter at LinkedIn. I had a chance to spend a little bit of time with it this morning. You got a bunch of stuff in here, and I like the way that you're putting it together. You know, I mean, you've got items, so the things that would be of interest to people who, have a broad interest in economics or a broad interest in understanding the economy. The one that I was drawn to immediately was just, the Fed and, what's going on with the Fed. There was a lot of chatter last week. And you and I have been off. I mean, spring break, I had some time off and then I got COVID, which I'll tell you, I would rather be on spring break than have COVID. But nonetheless, we're back and the talk had significant influence over the market in the middle of last week. And again, this is largely just chatter. This is not a decision from the Federal Reserve, but it sure sounds like cuts are not imminent to the borrowing rate. And in fact, I picked up a piece this morning in Wall Street Journal where Jamie Dimon at Chase is saying that he's thinking that perhaps we'll even see an increase in rates and maybe 8% mortgage rates to come here in the second half of the year. What's your take on what's going on?
It is interesting that you're talking about mortgage rates because the title of my article was, here's why mortgage rates won't fall in 2024. There's so much going on. But ultimately there are three things, right? Number one, stronger than expected economic growth, causing investors to reprice and update their expectations about inflation and the path of the Fed funds rate, right? So you have a surprise, in the first 3 months of this year. First, inflation came in higher than expected, with the annualized 3-month exceeding the 6-month, basically suggesting that inflation may have reaccelerated a little bit in the first quarter of this year.
And I think anecdotally, I think people are seeing that. I mean, not just at the fuel pump, but elsewhere, in their grocery carts.
Totally. Food and energy prices, for sure, are showing an uptick. You're also seeing the fact that, the treasury supply, right? Government spending has been somewhat inflationary, right? You have massive increases in fiscal deficits that are basically acting to stimulate the U.S. economy. And, when you have the supply of treasuries increasing, but you don't have the Fed buying large quantities of U.S. treasuries, then, well, guess what? You're going to have higher yields on treasuries. And so that's kind of where pressure on the 10-year yield and by the way, yields on all treasuries, treasuries of all maturities and mortgage rates is coming from. So you got that inflationary stimulus, fiscal stimulus. The fiscal deficit is expected to be around 6%. It's exceeded 6% already. It's expected to exceed 6% in 2024. Expected to remain above 6% and increase further into the future. That's inflationary, right? And so you have a lot of pressure, coming from those factors and slowing down the disinflation that we had seen for most of last year. You have a strong labor market. Now, the good news is the labor market has what you see is you see a continued increase in employment, which I think is positive, is good news. More people building stuff means more supply. A lot of the supply has come from an increase in labor force participation. And so I think that's a positive. And we know that because wage growth has eased, right? On a year over year basis, you see wage growth has actually fallen. The jobs report that came out last week showed wage growth fell from 4.3% year over year last month down to 4.1% this month. So that's been positive. However, you look at wage growth on a monthly basis and you look at the, from February to March, well, there was a small uptick in wage growth, not as big as the February uptick, but a small uptick anyway. So all of those factors are playing a key role into where Fed officials see the Fed funds rate going. Last week, Federal Reserve Bank of Atlanta President Raphael Bostic scaled back his forecast to potentially just one rate cut. Federal Reserve Bank of Minneapolis President Neil Kashkari raised the prospect of no cuts this year, right? And Fed governor, right, a voting member of the FOMC, sees no point in rushing to lower the policy rate, given the strength of the incoming economic data. Inflation expectations, also, by the way, reported at the end of this week by the University of Michigan survey of consumers, well, is expected to show an uptick in inflation expectations. And so again, with gas prices rising, by the way, I forgot to mention, with the troubles going on in the Middle East, all of that is, historically has been inflationary. And so, all of those factors are playing a key role here. Lastly, Fed Governor Michelle Bowman, who, by the way, is also a voting member of the FOMC, was first to hint at the potential for another rate hike. And let me just make sure that our listeners hear that, she's saying, look, if inflation, the base case is that inflation will continue to fall. But if inflation proves stubborn or even continues to reaccelerate, she sees the potential for another rate hike, something markets don't expect at all. And so you're listening to these Fed officials. They fall all over the place when it comes to their individual forecasts, but it gives you a hint at where the Fed dot plot could be going next time they meet. So, be prepared. Let's just be prepared. I think the pressure is up, not down. By the way, I should rephrase that. The pressure is up, not down when it comes to things like mortgage rates, right? I don't think the Fed funds rates will go up, but I think potentially it will remain high for longer. That we may not actually see the 3 or 4 Fed rate cuts that the markets expected back in December this year. It probably won't happen. The fact that it won't happen means that, a surprise for markets means that yields might go up, not down. And so I think people need to be prepared for that. And the stock market, the stock market's doing great. It's doing great because consumers are still out there spending. But if yields increase too much, right? If yields surprise on the upside, then perhaps we might see a bit of a sell-off. Look, earnings are coming in for the first quarter. And I would watch carefully. I would listen to what businesses are actually saying is happening out there in the real economy.
Appreciate your thoughts as always. For Dr. Orphe Divounguy, this has been Chris Krug. Subscribe to Everyday Economics and dozens of other quality podcasts at americastalking.com.
He ran for state office and was beaten. Started a business and failed. Ran for Congress and lost. But thankfully, Abraham Lincoln didn't give up. Persistence. Pass it on. From the Foundation for a Better Life at values.com.